Welcome to the Tons of Industry show. Today I have with me Brien Lundin, goldnewsletter.com. He's the publisher. It's the oldest gold newsletter in the world in terms of a premium paid newsletter. And he also hosts the New Orleans Investment Conference, which is the oldest gold-oriented show on the planet. So that is an incredible track record, and I love to have Brien on. It's the first time he's going to be on our channel, so it's going to be a very important interview. We're going to cover many topics regarding gold, silver, what's going on right now with the Fed, what's going to happen in 2019, as we're going to see a big shift in many of the key trends that rule 2018. And so without further ado, Brien, thank you for being on the show.
Great to be with you.
Hey, let's start with gold-silver ratio, 85-1 as we're doing this interview. Very, very rare to see it this way. What's happening next?
Well, when the gold-silver ratio gets to these extremes, it typically presages a major run in gold. And what you see, the reason why is in a longer-term secular gold bull market, you see silver outperform gold. It's really kind of a non-expiring option on gold. It's the poor man's gold, and it tends to move more than gold both on the upside and the downside. So the downside is where the danger comes in. It's much more speculative, but a lot of people really like to buy silver when the economic trends are favoring higher gold prices, because silver outperforms gold. So you're going to make more percentage-wise in silver typically in a gold bull market. So when you get to these extremes, it really shows an extreme in sentiment. When silver is much cheaper in relation to gold, it shows that the market has reached an extreme, and that as a contrarian, what you're seeing there is a potential turning point in the market. And the charts bear that out, that when the gold-silver ratio has gotten to extremes similar to where it is today, then a big turnaround has been in the offing.
You know, one of the most interesting things about this is that every time that the gold-silver ratio has reached this extreme and silver starts to outperform gold, the mining shares actually outperform both of the metals. And so it looks like there's a big correlation between the underperformance of silver and the underperformance of mining equities. And on the flip side, you see that every time it starts closing the gap towards 65-1 and 60-1, you see a big rally in the mining shares. We saw that in 2016. We saw it in the early 2000s. We saw it in 2009. Do you foresee this also in 2019, or do you think that the mining equities will still have a long ways before they bottom? We saw 95% of them hitting 52-week lows in September, so that's a very, very unique negative sentiment towards them.
Absolutely, and you are completely correct. And I should have mentioned that as well. The mining stocks, the gold mining stocks, do the same thing. They tend to, in some cases, they tend to lead gold, and they're a signal that gold prices may be rising, but they also outperform gold in a typical kind of a secular long-term bull run, one that's based on monetary issues and not crises of any sort. We did see the mining shares underperform gold after the 2008 credit crisis, because that was a credit crisis. People wanted gold. They didn't want paper representations of gold. So also we had at that point rising energy prices that crushed the profit margins of a lot of miners. So that was a rare occasion where the miners actually underperformed gold. But generally, the miners do offer leverage to gold, again, to the upside and to the downside. But what we're seeing now is that they're leveraging gold to the upside. I actually came up with an indicator called I'm calling it the London Gold Strength Indicator. And what that does essentially is, on any day trading, it just sums the percentage gain in gold, percentage gain in silver, and the percentage gain in the Gold Bugs Index, which is an index of unhedged gold producers. And on some days, that index can be as high as 10 or 11 if you have a really positive day in the market. On some days, it can be as low as negative 5 or 10. But generally, if you add up those percentage gains, what happens is the gold stocks move more than gold, silver moves more than gold, and you have a really strong positive number. If you have gold going up, say 0.5% or 0.75%, and silver and the mining stocks not supporting that move and not validating that move and actually being down, that's usually the sign of a short-term blip in the gold price that's based on some kind of a geopolitical crisis. In other words, a trend that's going to come and go and reverse itself very quickly. So you really do want to see silver and the mining stocks, the gold stocks, leveraging the gains in gold to indicate a longer-term, more structurally important move in the metal.
Now, Brien, I want to ask you, we've seen the Fed raising rates 8 times. 8 times in 3 years, that's a very lengthy tightening cycle. Not only lengthy in years, but lengthy in terms of how many times they've hiked. We're doing this interview 4 days before there's going to be another rate hike decision or an interest rate decision. We've seen Jerome Powell going from we're a long way from neutral to we're just about neutral for this economy. What's next? What's next for the policy for the Federal Reserve? Are they going to chicken out on doing many more rate hikes? And how does this all play out with ECB and the BOJ not even close to raising rates as a policy?
Well, yes, they're going to chicken out, to put it simply. About a year ago, I was called crazy for my predictions that the Fed would be hard-pressed to raise rates at all after this December, after 2018. And in a worst case, they would have to stop their rate hike campaign by mid-year 2019. Now we see a number of people joining in and taking that as really the consensus view. So it's gone from crazy to consensus. And what's happened is we've had weakness in the stock market that has worried the Fed because these days the stock market is the economy. It used to be that famous saying that the stock market isn't the economy, but then the Fed came around and they pumped up financial assets to create a wealth effect. And now household wealth as a percentage of disposable income has reached extremes never before seen. The U.S. economy is now dependent on high equity values. So when you have these stumbles in the stock market, it scares the Fed. And so we're going to see another rate hike next week, most likely. The odds of that rate hike, the consensus expectations have decreased from about 90% to about 75%, but it still seems very likely that this Fed won't surprise the market and hold off in December. It looks like they're going to get one more rate hike. But for 2019, there's a very good chance they won't hike at all, or at least not till March at the earliest, or perhaps June.
Now, I want to ask you about Ray Dalio, and I want to ask you about BlackRock founder Lior. Both of them are very, very bearish right now. Not only bearish, but they are warning. Their warning signals are very serious. So Ray Dalio is comparing this period to the 30s in terms of the rise of populism, the wealth gap, and the need of the governments to either do austerity measures, to raise taxes on the individual, or to cut on entitlements. We just saw what happens when you raise a little bit of gas tax on the French people, and I wonder what will happen if any president of the United States says that Social Security is going to be postponed until you're 72, or if you want to get Medicare, then you need to be in good shape, or if you want to receive some some Social Security, you need to still be employed and have a pay stub. All these things that they can do, because these are not set in stone. These are entitlements and not rules or laws or constitutional, privileges. So I and then what Larry Fink is connecting to this is the fact that 40% of the federal deficit, the federal budget, is funded by foreigners. In other words, every time a tank is running its gas bill, every time an airplane shoots a bomb, every time something happens internally with education, every time the defense budget wants to become larger, every time you want to pay an American income security or veterans, 40% of it is funded by other countries. And so he's saying you don't want to antagonize your bankers, your creditors, basically. And he's talking about just the fact that Trump is trying to reshuffle every card in the book. Obviously, with the right intention of making sure that the United States is ready for the future and that they don't continue to get outsourced and marginalized. But on the same on the same breath, this is causing other countries to think about how they lend money to the United States government. So what they're both saying is that there's going to come a need for the United States government to print currency outright because they won't be able to depend just on the auctions and on paying low interest rates on bonds. So that's why Ray Dalio has a huge position in gold, and through Bridgewater. Do you see a big problem for the U.S. going forward in terms of in terms of funding their deficits, because we have an entire generation, the millennials, who still have not participated in the stock market, still haven't bought a home. So there's growth, internal growth, and organic growth baked in the cake. Do you think this will not be enough to meet these trillion-dollar deficits?
Absolutely, it won't be enough. And one of the points I've been making in Gold Newsletter for some time is that we're not seeing anything new under the sun. This is nothing novel. These problems, this situation is the same that's bedeviled civilizations for all of human history for thousands of years. In ancient Rome, the government overspent. They overspent on foreign wars. They overspent on entitlements and other excesses, and created huge debts. And to pay for all of these debts, they devalued the Roman denarius. And that's what happens. Governments have always done this. They've always overspent, and in every instance, the prescription was the same. They devalued the currency to depreciate the debts, to devalue the debts themselves, and that's what's going to happen. Dalio's absolutely correct. There's no way that you can raise taxes in this environment. There's absolutely no way you can cut spending, and the debt is so large at this point that even at unprecedented rates of sustained economic growth, we couldn't grow our way out from under them. So the only thing that remains is some significant level of dollar depreciation, and it's going to happen. It's inevitable, and people need to get prepared for that, and gold is the way to get prepared.
Is the yield inversion good for gold?
Well, it's a sign of upcoming economic weakness. It is a very good recession indicator. And if we do have a recession or any kind of a significant economic downturn, the Fed does not have room to cut rates anymore. That's the real reason they've been trying to get over 3% on the Fed funds rate, because anything less than 3% has little to no effect on the economy. The average rate cut in a recession is 5 percentage points, 5 full percentage points. They can't even approach that level these days, considering the size of the debt and the cost of servicing that debt. So they don't have room to cut in the next recession. What will happen once we have a sign of an impending recession, or we realize we're in one, is that the Fed is going to have to very quickly go right back to quantitative easing. And it's going to have to do more quantitative easing than it ever has before, because the patient has developed a tolerance for the drug. And it's going to take more quantitative easing to get the same economic effect. So we're in this cycle where there's boom and bust, and with every bust, we don't really get to bust. They load us down with palliatives and aspirin to ameliorate the fever, but they never cure the disease, and it just keeps getting worse and worse and worse. We've got another cycle that's coming up. It's inevitable, and I think it's going to be coming up fairly soon. And people are going to be glad that they own gold if they can buy it now to prepare for this eventuality.
Well, and I think what's interesting is that even though they've raised rates 8 times, still Fed fund rate is much lower than the CPI official inflation stats, and not only that, but the 10 years is right there on the inflation stats at par. So we're still, even after 3 years, we're still at an environment with real interest rates about zero in the U.S. So that will be very interesting to see what happens if they decide to end the QT program. I want to ask you, Brien, where can people check out more of your work? What do you offer, and can you plug people into how they can follow you?
Yeah, they can go to goldnewsletter.com and they can get actually a free sample issue of the newsletter, and they can buy a single issue. We have our upcoming year-ending double issue coming up that's going to recapture or present highlights of our recently concluded New Orleans investment conference, as well as my top 10 picks for the end of the year. I'm predicting a year-end rally in gold and an early year 2019 rally in gold like we've seen the last 3 years. So I've picked 10 top stocks to take advantage of that. So they can actually order that single issue and get a free sample issue at goldnewsletter.com.
Brien, thanks a lot for taking the time here.
Great to be with you. Thank you so much.